Thanks for joining Kevin and I for the market update for the month of May. As you'll note, Harry's not in this week. Unfortunately, he had a back surgery a couple weeks ago, so we've been out without him for the last couple of weeks, but hopefully he will be back in the office later this week if any of you want to reach out to him. But yeah, May was a solid month for the markets. We saw after April's little pullback, we had a nice bounce in May across the board. U.S. stocks, as measured by the S&P 500, were up 4.8% in the month. Canadian stocks, as measured by the S&P TSX, were up 2.5%. And globally, European developed and Asian markets, as measured by the MSCI EAFE index, were up 3.3% in the month of May as well. We also saw interest rate movement. Interest rates, market prices came down a little bit, so bonds had a decent month in May as well. What was happening in the world's largest economy, the U.S., Kev?
Well, we did see the economic growth slow in the U.S. A bit. Previous estimates had showed U.S. growth at 1.6%, but the U.S. Department of Commerce later revised that down to 1.3%, but still positive numbers. We also saw core inflation in the U.S. Stay sticky at 3.6%. Now, the U.S. economy has shown surprising durability since the Federal Reserve started hiking interest rates more than 2 years ago. The much higher borrowing costs were expected to trigger a recession in the U.S. However, the economy has kept growing and businesses have kept hiring. Now, one other data point that's come up that we wanted to share was the U.S. saw record air travel over the Memorial Day weekend. A record 2.95 million U.S. travelers went through TSA checks for flights. Now, this is relevant because travel, especially air travel, is considered to be the most discretionary of discretionary spending. So the fact that we're seeing more Americans take to the skies doesn't really highlight a consumer that's running on fumes. Despite record air travel in May, we are still seeing signs that these higher borrowing costs and interest rates are weighing on the U.S. economy. For example, more Americans are falling behind on their credit card payments. We're also seeing businesses slow their hiring, even though they are still hiring. We're seeing fewer jobs posted. We also see larger companies like Target, McDonald's, Burger King are highlighting cost cuts or offering better deals in an effort to get a financially squeezed consumer to continue to spend money. David, what was happening in the Canadian economy?
Well, Canada has painted a similar picture to the U.S., although I would argue that our Canadian consumer might be in a slightly worse position than its U.S. counterpart. But similar to the U.S., Canada's GDP for the first quarter was a little bit lower than expected. GDP in the first quarter of 2024 in Canada was 1.7%. Economists had expected it to come in around 2.2%. So definitely a little bit more weakness there. And then also inflation in Canada is definitely moderating a lot faster than it is in the US. I think that's due in large part to the fact that our consumer may be in a slightly weaker position than in the US. Inflation in April was at 2.7%, and this is down from the March rate of 2.9%. So inflation is definitely headed in the direction that the Bank of Canada wants to see. And amid these data points, weaker than expected GDP growth, moderating inflation, a lot of economists, or maybe half of economists, are now forecasting that the Bank of Canada may do its first rate cut at the June meeting, but the jury's still sort of out on that at the moment.
As we approach the midway point of 2024, we're really happy with the way the economic landscape has been shaping up. Inflation is continuing to moderate. The average consumer is still doing okay despite high interest rates. And we're seeing economies show signs of cooling off, which, as we all know, needs to happen in order for central banks to start to consider cutting interest rates. Now, we don't have a crystal ball to look forward, but we are happy with the way the year has progressed so far, and we're happy with what we see moving forward, and we think that the markets will continue to perform well throughout the end of the year. If you do have any questions, always feel free to reach out to Harry, David, or myself at any time.
Take care.